Welcome everyone to CTBC Financial Holding Company's 2022 third quarter earnings conference call. All lines have been placed on mute to prevent background noise. After the presentation, there will be a question and answer session. Please follow the instructions given at the time if you would like to ask a question. Today's host will be Ms. Rachel Gao, spokesperson of CTBC Holding, Ms. Megan Shih, CFO of CTBC Holding, and Mr. Bohong Ye, Executive Vice President of Taiwan Life. And now I'd like to turn the call over to Ms. Rachel Gao, spokesperson of CTBC Holding. Ms. Gao, please proceed.
Hi, good afternoon. This is Rachel. And since I'm the first participant, the new participant to the IR meeting, let me introduce myself briefly. My name is Rachel Gao, and I have been working at CTBC Holding for 26 years. And I was relocated from Tokyo Star Bank this August. And before my experience at Tokyo Star, I was also doing IR and also CFO at the holding company and the bank. So maybe some of you are quite familiar with me. And today we also have a new participant. It's the CFO of the holding company and the bank, and her name is Megan Shih. And she has been working at CTBC, especially in finance area, for more than 20 years. So she is very experienced, and then we try to have the new management to be younger and then try to promote more managers at the bank and the holding company. And then let's start today's analyst meeting. Thank you.
Thank you everyone for joining CTBC's third quarter 2022 earnings call. Please turn to page 4 on performance highlights. CTBC Holdings net profit was 7.9 billion in 3Q and 32.2 billion in the first 9 months, down 1% QOQ and 31% YOY respectively. ROE reached 12% with EPS of $1.60 in the first 9 months. CTBC Bank's net profit increased 45% QOQ and 27% YOY, attributable to strong loan growth and margin expansion. Taiwan Life's net profit dropped QOQ and 77% YOY due to COVID policy-related claim costs and subdued investment gains. Overall, the group's capitalization remains sufficient. CTBC Holdings CAR was at 123.1%, while double leverage ratio was contained at 123.9%. CTBC Bank's capitalization was strong, with CAR at 14.2% and CET1 ratio at 11.1%. Asset quality was sound, with NPL ratio at 0.5% as of 3Q and benign credit costs of 22 basis points in the first 9 months. Taiwan Life's RBC ratio stayed sound at 305%. Taiwan Life announced it would reclassify partial financial assets in October according to IFRS 9 in order to further strengthen its equity asset ratio and better withstand market volatilities in the future. On recent updates, Holding continued its commitment in ESG and was selected to join FSC's Coalition of Movers and Shakers on Sustainable Finance in September. Page 5 on profitability. Holding's first 9 months net income was 32.2 billion. EPS was $1.60. Group ROE was 12% and ROA was 0.6%. Page 6 on capital ratio. We remain well capitalized with group CAR at 123%, Life RBC ratio at 305%, Bank CAR at 14.2%, and CET1 ratio at 11.1%. Page 7 on profit breakdown by entities. In 3Q, Bank net profit reached 12.7 billion, up 45% QOQ, supported by growth in net interest income, fee income, and trading gains. Life made a loss of 3.7 billion, mostly due to claim costs and reserves related to COVID policies. Other subsidiaries, including securities, venture capital, and Taiwan Lottery, all reported earnings growth. Holdings consolidated net profit was 7.9 billion, down 1% QOQ. In the first 9 months, bank net profit reached 28.9 billion, up 27% YOY, driven by increases in net interest income and trading gains, and contained growth in operating expense. Life profit was 5.2 billion, down 77% YOY, mostly due to COVID policy-related claims and lower investment income on base effect. Holding reported consolidated net profit of 32.2 billion, down 31% YOY. From the table on the right, bank and life contributed 90% and 16% to Holdings' first 9 months profit, respectively. Page 8, on net profit movements. In the chart above, operating revenue was up 14% QOQ, driven by growth in net interest income, fee income, and trading gains. Provisions were flat QOQ, and credit cost in 3Q was 25 basis points. Expense was up 4% QOQ. As for life, 3Q pre-tax profit declined mostly due to claim costs related to COVID policies. On the bottom, operating revenue was up 10% YOY, as loan growth and widened net interest margin underpinned increase in net interest income. Provisions were up 19% YOY, mostly due to impact from LH. Credit costs remained benign at 22 basis points. Expense was down 2% YOY on lower ESOP valuations. Life pre-tax profit was down 63% YOY on COVID policy-related claim costs and subdued investment income. Holdings pre-tax profit reached 46.8 billion, down 12% YOY. Overall, Holdings net income reached 32.2 billion, down 31% YOY. Page 9, on revenue breakdown excluding life. Total revenue was up 14% QOQ and 10% YOY. Net interest income was up 9% QOQ as loans increased and net interest margin widened due to rate hikes and changes in loan mix. Net interest income was up 26% YOY as loans grew and net interest margin widened due to changes in loan mix and higher yields on marketable securities, benefiting from rate hikes. Fee income was up 5% QOQ, partly due to increased wealth management fees, as rate hike movement spurred sales of bonds. In addition, corporate, credit card, retail, lottery, and investment trust fees increased. Fee income was down 6% YOY, as volatility in capital markets led wealth management and securities fees lower, but corporate, credit card, retail, and investment trust fees increased. Combined derivative, FX, and trading gains was up 95% QOQ, driven by higher trading income from FX-related products, in addition to dividend income and mark-to-market gains on securities. Combined derivative, FX, and trading gains was down 7% YOY due to lower trading income at securities and venture capital subsidiaries. Long-term investment and other income was down 29% QOQ due to higher lottery rebates to MOF, and was down 67% YOY as the bank no longer booked long-term investment income from LH after consolidating the entity. Page 11 on bank's loan breakdown. Total lending with credit card revolving was up 7% QOQ and 17% YOY. The bank consolidated LHFG in 4Q21. Excluding the impact from LH, total lending was up 11% YOY as of 3Q. NT dollar corporate loan was up 15% QOQ, driven by working capital needs. NT dollar corporate loan was up 13% YOY, driven by higher investment demand, working capital needs, and property development. Foreign currency loan was up 6% QOQ and 27% YOY. Excluding the impact from LH, foreign currency loan was up 9% YOY. Mortgage was up 3% QOQ and 13% YOY, supported by stable business momentum and our participation in lending to civil servants. Unsecured and other loans were up 2% QOQ and 6% YOY, mostly on growth in unsecured consumer loans as we continue to expand our customer base. Page 12 on foreign currency loan breakdown. Foreign currency loan accounted for 37% of total lending. Overseas subsidiaries accounted for 57% of foreign currency loan, with TSB and LH being two larger subsidiaries. Overseas branches accounted for 31%. OBU plus DBU was 12%. Looking at the foreign currency loan breakdown by region, Japan accounted for 30%, Southeast Asia 28%, Greater China 15%, and North America 15%. Overseas subsidiaries loan was up 34% YOY, driven by the consolidation of LH and solid business momentum at U.S., Indonesia, and Philippines subsidiaries reporting double-digit loan growth. Excluding the impact from LH, overseas subsidiaries loan was up 1%. Overseas branch loan was up 17% YOY, as Hong Kong, Singapore, New York, and India branches observed double-digit growth. OBU plus DBU was up 25% YOY, driven by growth in trade finance and syndicated loans. Page 13 on bank deposit mix. Total deposit reached 4.5 trillion, up 6% QOQ and 15% YOY. On the right, total NT dollar deposits were up 5% QOQ and 10% YOY. NT dollar savings accounted for 62%. Total foreign currency deposits were up 6% QOQ and 22% YOY. Foreign currency savings accounted for 51%. Page 14 on loan-to-deposit ratio. Based on average loans and deposits, overall LDR was 70.5%. NT dollar LDR was 77.6%. Foreign currency LDR was 61%. Page 15 on NIM and spread. In 3Q, foreign currency spread was 2.7%, up 17 basis points QOQ, due to rate hikes and changes in loan mix. NT dollar spread was 1.77%, up 8 basis points QOQ, driven by rate hikes and favorable changes in loan mix. Overall spread was 2.1%, up 9 basis points QOQ. In addition, rate hikes led higher yields for marketable securities. 3Q NIM was up 5 basis points QOQ at 1.62%. Excluding impact from LH, NIM was 1.58%, up 5 basis points QOQ. NIM in the first 9 months was 1.55%, up 16 basis points YOY, benefiting from rate hikes. Page 16 on fee breakdown. Total fees were up 6% QOQ and down 7% YOY. Wealth management fee was up 6% QOQ, driven by increased sales of bonds as rate hikes trigger rises in bond yields and prompted customers to invest in bonds. Wealth management fee was down 24% YOY as volatility in capital markets impacted customer demand and caused sales of bank assurance and mutual funds to weaken. Credit card fee was up 4% QOQ due to higher consumptions driven by traveling and sales season in summer. Credit card fee was up 15% YOY due to recovered consumptions, supported by expanded customer base and business ecosystems, and further penetration of mobile payments. Retail business was up 7% QOQ and 15% YOY due to increases in ATM and loan-related fees. Corporate business fee was up 5% QOQ on higher syndicated loan and trust fees, and up 26% YOY, driven by syndicated loan, trust, and loan-related fees. Overseas subsidiaries fee was up 3% QOQ, as corporate fees increased at TSB, and up 15% YOY, mostly due to the consolidation of LH. Lottery fee was up 8% QOQ due to higher lottery sales, and relatively flat YOY due to a lack of high price this year. Page 17 on wealth management fee. For wealth management fee breakdown in 3Q, bank assurance contributed 58%, mutual fund 22%, custodian and trust 4%, and others 15% to total wealth management fees. Page 18 on cost income ratio. Bank operating revenue increased 12% QOQ, while operating expense was up 4% QOQ, leading to a lower cost income ratio at 46.5% in 3Q. In the first 9 months, cost income ratio was 52.2%, lower compared to the same period last year, mostly due to growth in operating revenue and decreased ESOP valuations. Excluding ESOP impact, cost income ratio would be 53.8% in the first 9 months, which is lower compared to 56.5% in the same period last year, indicating contained growth in operating expense. Page 19 on asset quality. Asset quality remains stable with NPL ratio at 0.5%. NPL coverage ratio was 322%. Excluding impact from LH, NPL ratio was 0.36%, and NPL coverage ratio was 378%. 3Q credit cost was 25 basis points, down 1 basis point QOQ. First 9 months, credit cost was 22 basis points, up 1 basis point YOY, mostly due to impact from LH. Excluding impact from LH, first 9 months, credit cost would be 16 basis points. Moving on to life business. Page 21 on total premium and first year premium. Total premiums were $32.5 billion in 3Q, up 2% QOQ. First 9 months, total premiums were $106.9 billion, down 32% YOY. FYPs were $12.5 billion in 3Q, down 6% QOQ. As sales of U.S. dollar single-pay interest-sensitive policies declined, but sales of health and investment-linked policies increased. First 9 months, FYPs were $48.2 billion, down 43% YOY, as volatile capital markets affected sales of investment-linked products, and customers turned to interest-sensitive policies that capture rate hike trend. FYP market share was 7.7%, ranked number 5 in the industry. Page 22 on FYP breakdown by products and channels. On the left is the product breakdown. Investment-linked products accounted for 17%, interest-sensitive policies 78%, health and PA 5%, and traditional 1% of FYPs. On the right, in terms of channels, 51% of FYPs came from CTBC Bank, 33% from external banks, 9% from Thai agents, and 7% from insurance brokers and others. Page 23 on FYP breakdown by type of payment and currencies. On the left, regular pay products accounted for 42%, and single pay products accounted for 41% of FYPs. On the right, foreign currency policy accounted for 69%, and NT dollar policy 15% of FYPs. Page 24 on FYPE. First 9 months FYPE was $13.8 billion. On the right is the FYPE mix for your reference. Page 25 on investment asset mix. It's reached nearly $2 trillion. Taiwan Life took suitable opportunities to realize some profits and increase its cash holding. In terms of portfolio breakdown, cash accounted for 5.1%, domestic fixed income 9.4%, overseas fixed income 60.1%, equities 9.6%, mortgage 2%, policy loans 1.3%, real estate 4.7%, and mutual funds 7.8%. On the right is the pre-hedge return for each type of investment assets for your reference. Equities position generated a negative return of 3.2%, largely due to loss at PNC. Page 26 on investment yield, cost of liability, and break-even point. In the first 9 months, Term Life still maintains a positive investment spread. With impact from PNC, overall investment yield after hedge was 3.31%, and recurring yield before hedge was 2.51%. If excluding impact from PNC, overall investment yield after hedge was 4.26%, and recurring yield before hedge was 3.47%. Cost of liability increased 4 basis points YOY to 3.09%. Break-even point continued to improve at 2.71%. Page 27 on hedging mix. On the left, 43% of overseas investment assets were foreign currency policies, 33% were fully hedged, 10% were OCI position, and 14% were unhedged. On the right, FX reserve amounted to 14.9 billion as of 3Q. NT dollar depreciation resulted in hedging gains of 40 basis points in the first 9 months. Overall hedging costs declined 168 basis points YOY from the same period last year. Next section is the ESG highlight for your reference. That concludes the presentation.
Thanks, Janet. Before we move into the Q&A section, I would like to have a highlight of the performance for the first 9-10 months. First of all, for the CTBC insurance, in October, in our model that we took the affection rate up to 46%. So for year to October that we now book 14.3 loss on the COVID policy. And the one thing to remind is it's about 5 billion kind of additional loss that we took in October, but in our financial statement, it's going to reflect it in the third quarter financial report. Since the CTBC insurance loss, we don't think they're going to repeat again. So if we look at the overall financial holding company earnings at the after-tax basis, for the 3 quarters is 32.2 billion, which was down about 30.7% compared year-on-year to 2021, with ROE at 11.9% and EPS at 1.6 NT dollars. But if we took the COVID policy excluded, our earnings was actually 44.4 billion and slightly declined compared to last year at 4%, and ROE gonna stand at 16% with EPS at 2.22 dollars. So in the sense that we hope that for 2023 that we can get away with COVID policy issues and then have a better future going forward. And before we move in, I would like to cover some of the questions that recently frequently asked by investors. One is whether we're going to do additional recapitalization at the holding company. And as you heard about the presentation that currently for the holding company, the bank, and our life insurance, the capitalization is actually at a very sufficient level. And even though we are considering a recapitalization at CTBC Insurance, but its parent bank, its parent company, the Taiwan Life, gonna do the recapitalization. So currently, for the holding company, we don't consider there's a need for recapitalization in the near future. And another question that is our dividend policy. For the 3 quarters, the after-tax income is 32.2 billion. Although that we have some mark-to-market loss at the book, but so far that we still have undistributed earnings at the book, and they're still available for distribution for our dividends. And we do think that we have the payout capacity, and we also intend to maintain a stable dividend payout policy. However, the final numbers that we still need to confirm with the regulators, and also were subject to the board confirmation. So since the bank gonna book a record high earning this year, so the holding company, the bank earning gonna upstream to the holding company. I think that can support the holding company to pay out dividends for the investors. So that's summarize some key questions from investors. And before we move into the Q&A, I have the Bo-Hong to maybe summarize some of the questions related to insurance or life part. Thank you.
For COVID policy, we already recognize 40.3 billion loss on our P&L, and for application for claim application up to at the end of October was 12.4 billion, which was infection rate around 38%. We recognize we use the assumption of 46% on our P&L, and we since we already recognize the loss, so the RBC and the net worth was negative for a PNC company. So we need to the third time capital injection to PNC from Taiwan Life. Even we need to capital injection to PNC. Our for life RBC still around 300% and above, and the net worth was it is 4.58%. And for accounting reclassification, the impact was our net worth ratio from 3% up to around 5%. We move around 100 billion OCI position to AC, and the net worth impact was 33 billion. Thank you.
So we open up the floor for questions. Thank you.
Yes, thank you. Ladies and gentlemen, we will now begin our question and answer session. If you wish to ask the question, please press 01 on your telephone keypad, and you will enter the queue. After you are announced, please ask your question. Should you wish to cancel your question, you may press 02. Thank you. Now please press 01 to ask the question. Thank you. And our first question is coming from Jamie Huang of JP Morgan. Go ahead, please.
Yeah, thanks for the presentation and take my questions. Two questions from me. First one is for the bank. If based on your numbers in the Chinese session on the ESOP impacts, then if we exclude that, the year-on-year OPEX at the banking side is actually up roughly around 10% year-on-year. Just try to understanding for this 10%, how should we read through this number? Where is the OPEX growth coming from? And should we expect the high single digit to maybe 10% OPEX growth to be a more normal base? That's the first question. Second one is still on the COVID policy impacts. I think what Bo-hong just mentioned, your total pool, the implied infection rate is roughly around 38% based on the claim application. I think the nationwide infection rate was roughly around 32% by the end of August. So based on your understanding and analysis, what are the key reasons the pool of your infection rate is actually higher than the nationwide levels? Thanks.
Hi, Jamie. Thank you for your question. Regarding your question on the OPEX expense, and the reason that you see a high single digit to 10% increase is because this year we actually has a LH, we consolidated LH. So that's but last year actually the LH was consolidated in the fourth quarter. So when you look at the third quarter number, it's actually not apple to apple. So that's the reason that you see a bigger increase in the OPEX.
For COVID policy, we did some analysis. We found that for our customer pool, more concentrate on city rather than suburban. That's the one of the reason. And another one is that I heard that some people since the symptom maybe some people have infected. The symptom is not so it's very light. Then they would not go to clinics. That's why. But if the people have the COVID policy, they will do that. I think it's another reason. So currently, at the end of October, the nationwide is 33% infection rate, but for our PNC is 38%.
We have a follow-up question on OPEX. I mean, if we exclude the LH impacts, then what's the underlying OPEX growth that we should look at on a more recurring basis? Thanks. Hello?
Hi. So for the bank, if we are not considering the ESOP impact and also we take out the LH impact, the overall operating expenses grew about 3%, mainly driven by the credit card promotion campaigns.
I see. Thank you.
Hi.
Thank you. We are now in question and answer session. If you would like to ask the question, please press 01 on your telephone keypad. Thank you. And next question is coming from Gurpreet Sahi of Goldman Sachs Hong Kong. Go ahead, please.
Thanks for the presentation and taking my question. I just wanted to check on the regular guidance regarding the growth target into next year, and also what kind of margin we can expect NIM for next year. Thank you.
Thanks for your questions. Actually, we are now still compiling our internal budget. I think I will wait until maybe next meeting with you, and then can give you more highlights on our growth target and also NIM. But currently, so far, we see the NIM is increasing since that the major financial market is still increasing the rate. And we still see strong loan growth from the market, especially post-COVID. And we see more demands from especially Greater China and Southeast Asia. And we'll hope that going forward that the loan growth will still maintain its current level. Thank you.
Okay. And can I quickly check on this insurance asset reclassification? So given that this has happened in the fourth quarter, so should we expect like excluding this one-off impact, so like the 5% equity to asset? So now whatever the yields do, we should expect no impact, so equity to asset should be stable at around 5%. Is that the way to think about it?
After reclassification, the net worth ratio, we do some sensitivity test. If the equity drop 50%, and the interest rate goes high 50 basis point, we still can maintain the net worth ratio 3% and above. For your reference.
Okay, so just checking, equity dropped 50%, 50, and interest rate rise by 50 basis points, 50. That's correct?
Yes, that's correct.
Okay, cool. Thank you very much.
Thank you. If you would like to ask a question, please press 01 on your telephone keypad. Thank you. We are now in question and answer session. Please press 01 on your telephone keypad if you would like to ask the question. Thank you. Now please press 01 on your telephone keypad if you would like to ask the question. Thank you. And there appears to be no further questions at this point. Ladies and gentlemen, we thank you for all your questions, and that will be the end of the conference. We thank you for your participation in CTBC Financial Holding Company's conference call. You may now disconnect. Goodbye.